Welcome back, everybody. As we can see, markets on a rally mode. S&P 500 is almost 2% in the green territory. Dow is up by almost 400 points, and Nasdaq Composite actually totally turns in the positive territory for the year. Of course, clawing back its steep losses for the year. We saw March minus 25. And right now, actually plus 25, which is in perfect equilibrium so far. As we can see, 8,996 points, pretty positive situation for the FANGs. I just wanted to mention a few stocks to watch as we're going to discuss in the third segment of the show. Lyft, Uber Technologies, which will post results after the bell, and of course PayPal, which is gaining more than 10% after the digital payments company reported sharp increase in new active accounts. Viacom and Brayton Technologies are doing also a great job. As we can see, most of them are in the really green territory. In particular, Viacom 14.05% in the green territory, and PayPal 12.88. Very quick look also at the fixed income. So far, the 10-year Treasury is yielding 0.64, the 2-year 0.14, and the 3-month 0.11. The dollar index on the other side is slightly below, actually below the 100 mark, 99.92, 0.25% lower today. Euro dollar 108. And of course, a little bit of optimism in the energy market. As we can see, WTI is trading $26.50 per barrel, and the Brent $30 per barrel. So why is this optimism on the energy market? Yousef Alshammari, editor-in-chief, C Markets, is going to help us to figure it out. Good evening, Yousef, and thank you so much for joining us.
Good evening, Alexandra. Very happy to be back with you on the show.
We're very happy to have you back on the show, that's for sure. Yousef, I was wondering, is the oil rebound based on hopes, or it's based also on some fundamentals? Is there any particular reason for this optimism over there? Because what we saw in the last 2-3 weeks was something unprecedented.
Yes. Well, if you want to recap what happened in the oil markets over the past few weeks, we've seen a major decline in the month of April, and as you know, due to the major decline in demand by between 20 to 30 million barrels, and that, as you know, the lockdown worldwide, 3 billion people are not moving, and aviation has stopped. So there's now easing in terms of lockdown measures, especially in the EU and the United States and Asia, and that has brought at least gasoline demand back into, as we can see, the trends of gasoline are slowly actually rising. The reports coming from the United States EIA are showing this for the second week that the inventories of the gasoline declined by more than 3 million barrels. And the expectations that demand will pick up starting from May and slowly improving until the second half of the year 2020. But I don't think we will see demand going back to pre-crisis level throughout 2020. At C Markets, we see demand coming to around 95 million barrels in December 2020. That's 5% less than the demand in 2019. So as you can see, prices are improving for oil. It's above $30, but still, it's not, of course, as compared to the pre-crisis level, but it is certainly improving with demand, with improvements in oil demand. We think that prices could hit around maybe between $40 and $50 by the second half of the year 2020.
How do you think will evolve the situation, let's say, in the medium to long term?
The situation, you mean, on the
yeah,
supply?
of course. When we talk about demand and supplies, this is the rule when we talk about commodities, and in this case, the word is awash in oil. There is so much oil, people don't have where to store it. So, I was wondering, what is the outlook in the medium to long term? Because, of course, when the world is going to restart, when we're going to be back to normal, people are going to start to travel, so they're certainly going to need it.
Well, as you know, OPEC had a major agreement on curbing supply, and the supply is being curbed by about 9.7 million barrels from OPEC, and the EIA will take about 5 million barrels per day into inventories, and in addition 5 million barrels a day will come from participating countries, especially in North America. Actually, there's been major shut-ins of major fields in the United States that would just yesterday in North Dakota, more than 500,000 barrels per day decline because of shut-ins. In Texas, in the Permian, there will be between 600,000 to 1 million barrel per day decline in production because of the shut-in of major fields. And the closing of these fields is certainly driven by the low price. And what that would lead to? That will, of course, lead to, number one, bringing back supply and demand faster into balance, combined with OPEC Plus cuts. And it will certainly reduce the burden on the inventories, because now with nearly the EIA inventory is nearly full. So we expect that they will remain at least more than 500 million barrels throughout the year 2020. So the I would call it forced decline from North American producers, and voluntary cuts from OPEC Plus is expected to somehow improve the supply and demand balance throughout the year 2020. But most importantly, demand will have to improve quite significantly. Otherwise, storage in strategic petroleum reserves will become a major necessity to support bringing supply and demand back into the balance.
I was wondering, what do you think about the major energy giants' earnings reports? We saw earnings of Exxon, Chevron, all of them had some problems on top and bottom line, not to mention their European peers like BP and, of course, Royal Dutch Shell. I just wanted to mention that when we talk about actually Exxon, one of the biggest companies, of course, after if we put aside Saudi Aramco, we saw ExxonMobil has cut $10 billion from its planned capital expenditures in 2020, which is around a 30% of budget cut. So what do you foresee for these companies? I also wanted to show very quickly to our viewers this beautiful chart that is coming from, of course, the Wall Street Journal. For instance, the market cap of S&P 500 energy sector at the end of 2019 was 1.16 trillion, and April 20th of 2020 so far is 638.7 billion. So this is a major slap, no doubt about it. I was wondering, do you believe these companies are going to, how can I say, manage to go through these hard times? Because certainly U.S. companies were took one of the hardest hit. Let's say it like that.
Well, as you can see, it was not very surprising to see a major decline in profitability from major giants. And as you know, the break-even price for many of these oil companies is quite high compared to Saudi Aramco. So that's a major reason. Shell profitability declined by about 47%, Chevron by about 67%. In fact, OMV in Austria even declined by nearly 100%. So the major reason for that is the break-even price, and where the fields where they are operating needs a price of at least $30 to $40 a barrel, and which has not been the case over the past, especially in April. But I think they number one, these companies will have to do significant spending cuts and efficiency in terms of how they spend, especially throughout the year 2020. We've seen the decline in, for example, in the shares of BP. It's to a level that reminds us to the disaster which happened back in 2011 in the Deepwater Horizon. which is something unprecedented. It's like more than 50% decline in the shares of BP. But I'm certain that with rebounding of prices towards the end of 2020, we'll see an improvement in their profitability. What this shows actually is that oil companies are still very much sensitive to oil prices. And although we've seen back in the days, in 2018, when we've seen some decline in oil prices, they've managed to improve their financial performance much better than what we've seen in the COVID-19 crisis. But I'm quite certain that they will rebound their profitability as oil prices rebound. But at the meantime, they will have to manage their spendings quite intensively.
Yes, absolutely. Many of them also suspended, of course, dividends. So that's pretty important for investors, no doubt about it. I was wondering, you just mentioned a very important point, in my opinion, and this is the break-even price. So how do you think, for how long do you think Russia and Saudi Arabia are going to manage to keep up with similar price tags?
Well, I think the price now is good. Above $30 Brent is good for both Saudi Arabia and Russia and most of OPEC countries. By the way, the break-even price there is it has got two meanings. Either break-even price for the oil company for oil production, certainly that's good. $30 is good. But when it comes to break-even for the national budget, I think Saudi Arabia will require a slightly higher price. But for Russia, I think they need something like $40. But in the meantime, I think the prices will be certainly much better than what we've seen before the COVID-19, especially in the April during April. And I'm quite certain that if prices continue to rebound especially in the second half of 2020, and it reaches to about $50, and I'm sure OPEC Plus would be willing to see a price at this level in order to bring back investments into the industry. So I think this is the price that you would see producers actually be very much comfortable with. Certainly, nobody would be comfortable with the prices below 50. Even in the United States, if the shale producers want to come back and restore the industry that they have invested billions of dollars in, the oil prices will have to at least be a $50 a barrel.
All right. Thank you so much, Yousef Alshammari, Editor-in-Chief, C Markets. Always great to catch up with you. Thank you so much for joining us. Have a great evening and have a great quarantine time.
Thanks a lot. Always a pleasure, Alexander. Have a nice evening.
Well, before we get our next guest on the line, I just wanted to show you very quick